Hello traders, Gary Wagner here. It is Friday, finally, the 12th day of October 2012. It is approximately 11 a.m. in Honolulu, making it 5 o'clock in New York, and this is the daily report for gold and silver. Significant pressure in the marketplace has pulled both gold and silver down lower across the board on the day. As you can see, current print on the board, 1753.78. The low is 1751.20 and a high of 1774.50. Silver also under pressure. That trading off about 1.5% on the day. As you can see, current print on the board, 33.50. It has had a low of 33.33 and a high of 34.31. Traders, there can be no doubt, today's trading activity in gold did give us compelling technical evidence, concrete technical evidence that a top, in fact, has been in place, and that area of resistance, which is the $1,800 mark, is a substantial resistance point that, at least on this particular occasion, gold was completely unable to take out. On today's report, I want to look at a couple of different scenarios, give you a sense or a feel for my take on the market, where I think this market's going to go both short-term as well as long-term, really cover the activity that we saw this week. And that will be all here on today's daily report. My daily traders know, the daily subscribers know, I had sent out a special trade alert letter, I believe it was about midweek. And I had noticed something within the marketplace that to me was significant and really pointed to the fact that we probably had a top in place, short-term top. We'll talk about that as we talk about the Elliott wave count in a little bit, but a short-term top in the marketplace. But on this particular stab, I realized that there was a high probability we would actually not see that market move past it. And really, what was that? To do that, I really want to pull up a candlestick chart. So let me go ahead and convert this chart for you. And here's really what I'm looking at. I've gone ahead and put our pointer up, straight candlestick chart, daily chart. And as you can see, this is the trading activity last week. This is the 4th of October. We have that tremendous move up. And if we take a look at the high that we got on that particular day, right in here, right at around 1794. That high, of course, just at about the same level as we saw before 93, but we didn't get the follow through, and that's the key. On the following trading session, this is the 5th, you can see it makes an equal high, is unable to move any further, and in fact begins to close lower on the day. It was at that point that what I realized was that there was a likelihood that we would see the market drift lower. And really, to see that, we want to go back a little bit further, because we saw a potential top back here. This is 1784, this is 921. Market drifts lower, but we had this tremendous up day. And this tremendous up day had really taken out all of the trading range of these prior areas. And that's really what made me believe that we might, in fact, have witnessed a very, very shallow correction, because what we saw was the market going to a 23% retracement level. The market did begin to trade higher. However, you can see, once again, back on the 4th and the 5th, the fact that it stalled and we really didn't get that follow through. At this point, I really believe that there was that likelihood, and the beginning of the week really gave us that evidence. I went ahead, we did raise our stops, of course. We got in at 77, we got out at around 57. After taking $114 out of the market on our last trade, we gave up about $20 on this trade. Silver, we're still trading that, and we'll talk about that towards the end of the show. Now, that being said, what is our forecast over the next couple of weeks? And as we get into mid-October and then into November, what are we really looking at in the marketplace? First of all, I am still firmly under the belief that this long correction that we witnessed after seeing that record top go to our record bottom here, 1520, 1920, that $400 move, that signaled the end of the correction. Of course, we talked about the fact when it broke above these tops right in here is when we initiated that nice long position, and that's where all of that profits came from as this market moved up. Now, once this market has moved up, the bad news is we are under a corrective stance. The good news is I can tell you that I have a 95% likelihood that we have completed our first intermediate wave 1, and that would be this wave right in here. With that in place, we have some good modeling that can really give us a solid indication of where this market might go to and how that particular scenario might play out. And that's what I want to spend a few moments and really discuss with you today. Because when we benchmark and look at Elliott Wave, what we're really looking to do is to take that wave number 1 and use that as a benchmark for all of the subsequent waves. And here's basically what we're looking at. If we take a look at the trading range from the beginning to the end, in other words, the low to the high, you can see we've got a pretty tremendous range, 1530 all the way up to just under 1800, and you can see this is where that market stalls. With that in mind, we then can plot our secondary corrective period. Now, you can see that it is at about the 23% retracement level. That's 1739. Now, is that going to hold? I can't predict the future, but the likelihood is if we are in a real corrective stance, we will probably get something a little bit deeper, which could take us to the 38% retracement level. 38% retracement levels just at around 1700. Also, traders, realize that when you do Elliott Wave modeling, you want to look at where is 50% and 61, because it is possible that wave 2 can be a steeper correction of the two corrective waves, meaning waves 2 and 4. Let's model this and let's make the assumption that we get a 38% retracement. In other words, what we witness is the market moving, wave 1 here, wave 2 here. Now we want to really go ahead and calculate where wave 3 might take us. And that's where it really begins to get fun, because wave 3, in terms of straight Elliott Wave rules, cannot be the smallest of any of the impulse waves. Doesn't mean it's going to be the largest. It can be equal to 1, but it should not be smaller or have less than 1. So what I'm going to do is this. I'm simply going to copy this line. They are scalable. So what that means is that they'll scale as the market goes up. And we're going to take a look at a couple of different scenarios. The first scenario is, let's assume you get a 50% correction, if that was the case. In other words, if what we witnessed in the market, and I'm not saying that is going to materialize, I'm just looking at different variables, you would get something like this. Wave 1 right in here, your corrective wave 2, and wave 3 just at an equal boundary would take you to a new record top roughly around 1950. So that's one possible way that it could play out. If in fact we get a shallower correction and it takes us to 38, you've got wave 2 taking us down to about 1699, 1700, but then you get a tremendous rise from this wave 3. That would take us just shy of $2,000 per ounce. But there's another way you want to look at it, and that is through the eyes of what's simply called a Fibonacci extension. Because what I just did was under the assumption that you would get an equal move in 1 as opposed to wave 3. Now, if we do the extension, and for the extension, we simply fix our low and our high, and then let's make the assumption of, say, 38%. And if we do that, what we want to do is to look at 100% of a move, 123%, 138%, all the way up to 161 are possibilities in terms of models for Elliott Wave forecasting of wave 3. So let's go ahead and fill those in. Now, traders, all I have done is run our Fibonacci extension, and I have run it with a Model of a 38% retracement, wave 1, wave 1 right here, wave 2, and then these are our different targets that we could see all the way up to 161% of wave 1. And so what we're looking at is 1972 would be the target we would look for if we had equal waves 1 and 3 at 123% over 2036 up to 161 at 2141. And traders, that's wave 3, because following wave 3 on this major count, we are probably going to get our corrective wave 4 and then a final drive up, or the final impulse wave, wave 5. And traders, that could take us definitely into some nice high ground in the market. So although the market has topped, although we are probably facing some sort of correction here, it's quite possible. I think the odds are in the favor. The only thing that would change it is new fundamental data that comes into the market that changes this wait and see attitude. The good news is that we actually now have a benchmark. Wave 1 is our benchmark and can really start to put together different scenarios and a really nice concrete strategy and game plan for the next 3 to 4 months. We are looking at a 420-minute chart, Japanese average Henkin format of silver. Silver, it's a little train that kept on rolling for us. Our stop, 33.20, low above 33.20. So we've done quite well of considering we're in at $29 plus change, $29.10, I believe. But here's what I'm looking at. You can see we've absolutely got real resistance at $35, just like 1800 in gold. But we also seem to be forming some sort of a base or some support right within this level. And this particular level, I'm going to go ahead and compress the chart so you can see where that number comes from. But my sentiment is this: if gold does correct, we will see silver probably following suit with that. But with that in mind, let's take a look at the market through the eyes of a compressed chart. Here we're looking at, really, this is the one high that we had at about, let me see if I can read that right, 37 and change, almost at 38. We can absolutely see this top right here at $35. And if we look at different levels of potential support, this is my take and observation right now. Of course, we have our stop right in here. If this holds, of course, we would see the market clip up, and in the same way, we have a 1 and then a 2 in terms of our Elliott wave count. What is probably a little bit more likely after this sizable move from $26 all the way up to $35 is a 50% retracement, and it's a 50% retracement of this particular correction right in here. The market's moved back up. This is 76% of that. You can see it makes it 3/4 away to this particular top here. That is a very logical point for it to go to in terms of a Fibonacci number. This would be extremely shallow if in fact it found support here. If it continues to go lower, it's going to stomp us out. We're going to look to re-enter that trade when we believe that both gold and silver have washed out in terms of a correction, and what we are looking at is the beginning of a impulse wave, wave number 3. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.